Hello and welcome. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. These are the top headlines that we're tracking at this hour. Markets consolidate at the start of the week. The Nifty trades below the 10,300 mark with low volumes. Biocon surges in trade after its Bengaluru facility got an all clear from its Bengaluru plant. Cement companies are among the top losers in trade after the Supreme Court extends the ban on the usage of pet coke onto the other states in North India. And Aberdeen's Kenneth Enkitwe finds Indian markets expensive, says there are other ways to play the India story.
Yeah, and he referred to the bond markets as well as a way to play the India story. But we'll get to that in a bit. We'll make you hear that slice of that conversation. As also a conversation with Bill Maldonado a bit later on in the show. What are the markets doing? Precious little. It's just been lying so flat throughout the session today. There are 6 odd points down, and you would see the broader end of the spectrum as well. The mid-cap and the small-cap indices will come up on your screen, as will the market breadth, and there's virtually nothing, almost nothing that the markets have done. So the market breadth is positive, yes, and you could argue that the mid-caps and the small-caps have done a tad bit better than what the large caps have. So the mid-cap and the small-cap indices will come up on your screen as well, and you will see that a marginal bit of outperformance for select names out there, and which is why the market breadth is positive, but about 0.5% on a day like this is nothing to really write home about. Bring up the Nifty heat map, and I would guess it's even Stevens with cement companies on the downside, and banks and financials are largely trading on the upside, and that's essentially the flavor. Though you do have ICICI Bank, which is down about 2.5%, but on the index and even at the broader end of the spectrum, cement is taking a beating. There's the likes of Ambuja, Ultratech, amongst others, which are correcting. And on the gaining side, GAIL has overtaken Yes Bank now as the top gainer, but Yes Bank holding fort by virtue of the Sensex inclusion, so up about 1.5%. IndusInd Bank had some gains to itself as well, about 1% higher, and Kotak Mahindra Bank about 1.25% higher. So good going really for financials in the session today. Not such a great day for cement names, but the broader markets, Pradeep, fairly active. The last time I checked, about 100 stocks hitting fresh 52-week highs as well.
Exactly. So while Nifty is kind of giving you 25:25 kind of a market breadth, if you look at broader market, there are more gainers than losers. Eris Lifesciences to begin with, after the numbers and acquisition, this stock is up, continues to remain strong, in fact, during the day. Logistics is another segment which has gained today. Gati is up now 6.5%, and also Navkar Corporation, if you look at this stock, has also done well, is up 7.5%, almost 8%, close to the day's high. Idea Cellular, among others, other key buzzers actually, but Jacob and RIIL, these two stocks often move together, especially when there is a news on Trans-Harbour Sea Link in Mumbai, and now when the award has actually, the contract has actually gone to L&T. Both these stocks are doing well currently at day's high, RIIL and Jacob. Venky's has also done well today. Well, there are news reports that government is considering new norms for meat and meat products, and an organized player like Venky's would stand to gain. This stock has moved up quite a bit in last 3 odd sessions. Radico Khaitan continues to gain, and in fact this is up 20% in 3 days if you look at Thursday, Friday and today. On the negative side, as Neeraj also mentioned, is the north-based cement companies which are quoting weak, JK Lakshmi and Shree Cement specifically, and HAG that remains weak as well, close to the 5% lower circuit.
Clearly, the broader markets seem to be outperforming today. Let's also take a look as to what's happening on the futures and options side. As Neeraj highlighted, the volumes today are definitely on the lower side. So even if you go by the trend, the markets have been trading in a very narrow range. In fact, Nifty's only been trading in that range of 30 to 35 points, currently just hovering around those levels of 10,280. If you could just pull up the futures and see what's the premium the Nifty futures are quoting currently. Remember, the futures premium has been going up, and currently it's just about 28 points. There's no major build-up on Nifty futures, and that's been the trend, mind you, in last few sessions. Let's also check for Bank Nifty, which added almost 6% in open interest on Friday, has added yet another 7%. So there has been some signs of fresh long build-up which has been coming for Bank Nifty. In today's session, if you look at the option strikes, clearly out of the money call strikes have seen once again open interest addition coming back. from the likes of 10,300 to 10,400 strikes so far have seen major addition. Well, going for the range in the near term, Nifty could trade in the range of 10,150 to about 10,385 on the upside. Just two stocks I want to highlight. Shree Cement has been highlighted since the morning, but today if you look at the cash volumes, the stock has fallen on very high volumes, and even on the future side there's been a huge short build-up. Open interest is up nearly 32%, and the other stock which we usually don't talk about is Tata Power. It's not a very liquid counter, but remember on Friday in the second half the stock saw a major surge coming about, and that buying momentum has continued in today's session as well, because if you look at the futures, Tata Power currently open interest is up almost 19%.
Well, let's get in a market voice on that note. PVK Mohan, Head of Equity at Principal PNB Asset Management Company, joins us on the show now. Good having you, Mr. Mohan. Thanks so much for joining in. It's a bit of a lackluster session, a day after the big India upgrade. What is your stance on the markets currently? Expensive and stay out, or are you deploying money at every single opportunity?
So I think we've been reasonably invested in the market, and we continue to be that way. I think at this point of time, our approach is a little more bottom up, given the concerns on valuation that you spoke about. I mean, we share that concern. So it's very bottom up. Look for ideas where, there are potential earning surprises possible. So it's I would say, pretty much bottom up market.
Earnings season surprised you in any fashion whatsoever, Mr. Mohan? I mean, by and large, as per our Bloomberg Quint analysis, there were a lot more companies meeting estimates or even beating estimates as compared to the ones which missed estimates. But the estimates is one thing, actual delivery is other. Anything that did, any theme, any sector that did meaningfully well this earnings season, according to you?
Yeah, I think actually that's been one relative bright spot in recent times, the Q2 earnings season. So I think we started off with a lot of some amount of skepticism how it would be post this GST introduction. But I think if you see the numbers so far, I mean, even if I look at it from a Nifty terms, I think we've had a 13-14% earnings growth for the Nifty universe, and that's probably the best in the last 6 quarters. I think, as you said, in terms of the positive surprises to the misses, I think positive surprises outdid the number of negative surprises by almost, I think it's a factor is about 1.3 or so. So that's again another 16-quarter high. So the number of companies, for example, reporting a decline in earnings, that's come off pretty sharply. So I think in terms of, even if you see the upgrades to downgrade ratio, it was heavily skewed in terms of downgrades till now. So that's pretty much getting balanced, so you had a few downgrades, but you had almost an equal number of upgrades. So I think this is the first quarter of double-digit earnings growth, and considering that we have a relatively muted base for the second half, we should see, I think, double-digit earnings growth, which then sets up for FY19. So I think the only caution is really that having so many false starts, the market probably would really like to wait for the actual numbers for the December-March quarters to flow through. But I think on the whole, there have been a fair amount of good surprises. In terms of sectors that you asked me, I think the surprises were clearly both in the global cyclicals and the local cyclicals. Sectors such as telecom did very well, autos, cement did very well, even financials, NBFCs continued to grow, and the banks positively surprised in terms of the even in terms of the asset qualities. So we had a fair amount of surprise, I would say, except for healthcare and maybe a little bit on the IT. You did by and large had reasonably quite a few positive surprises. Overall good. I think it sets the tone for the next few, at least the next 2 quarters. It's a wait and watch. I mean, having, so, as I said, many false starts.
Mr. Mohan, as you mentioned, you are looking at bottom-up ideas. If you could share with us, in which segments are you more likely to find those ideas these days?
I think it's very scattered, honestly. So, you could have, one of those odd opportunities. It's sometimes, I mean, even if I look at a portfolio, what we've added, something in the chemical space, something in the auto ancillary space, something even in the global commodity steel space. So, it's very fertilizers, so it's extremely scattered. Honestly, at this stage, we were very difficult to pick up a trend in terms of sector. So I think it's across the board, so only thing is, the idea there is, can we find something where we believe the earnings could surprise the market expectations positively. So it requires some incremental trigger or, something happening at the company level, a company specific driver. So that makes the job a little harder, but I think that's what it is, considering that our focus is a bit on value. We don't want to chase high priced or high P stocks at any price. So it's very scattered at this point of time. It's difficult to pin it down to one or two sectors.
Mr. Mohan, one sector which has been doing well, at least in the last 2 to 3 trading sessions, we've seen a good move coming about for logistics stocks. You've got the likes of Gati, Patel, Integrated, Blue Dart, all these stocks are registering good gains. Just wanted to know, what is your outlook, because this was one sector which was talked about before GST implementation.
Yeah, so I think the sector does hold great promise. Once I think the real upside in this is once this whole GST rollout gathers full momentum, and you have this whole concept of fewer big warehouses and then transporting things from there on to all parts of the country. So it's a story. I think our belief is it's a story for the long term. So people, if you take a 3 to 5 year view, probably that theme will clearly play out. I mean, there's no denying the fact that given the logistics costs are so high in India, there is great scope for rationalization there.
Okay, Mr. Mohan, we'll leave it at that. Thanks so much for taking the time out and joining us and speaking to us at Bloomberg Quint.
Thank you. My pleasure being on the show. Thank you.
That's Principal PMB with their thoughts. However, let's move on to the stock of the day. Arguably has to be Biocon. The stock gained as much as 7% in trade today after its Bengaluru facility received an all clear from the US drug regulator. The stock snapped a 6-day losing streak, which started last Wednesday, of course, and has gained almost 14% since then. Let's also listen into what the management had to say post this clearance.
The agency had basically indicated to us that we would need to implement the CAPA plan and update our file and resubmit the dossier, which is what we are doing now. And hopefully, we should, hopefully get approval within 4 to 6 months for pegfilgrastim. And as far as trastuzumab is concerned, obviously we are, keeping our fingers crossed for the 3rd of December. We, at the moment, don't have any open issues as such with US FDA for any of the CGMP inspections.
Okay, in fact, Pradeep has an interesting chart to share with us on Biocon. Pradeep, what do the charts indicate?
So basically, the question we are trying to answer is whether or not one should hold on to a long position in Biocon, because if you look at it, the stock has moved up by around 13-14% over last 4 sessions. So there's a daily chart. You can look at the movement in just 4 odd sessions, including today's move, and after gaining 13-14%, now if you hold on to a position, what is the possibility that it will keep moving up? So if you look at the price movement, first of all, the stock has not really been able to close above 420 mark over last 4 months. So whenever it reaches that point, there's a correction. So this is a strong hurdle, which means unless it crosses 420, it would be difficult for one to really justify the risk reward here. Also, if you look at the volumes, in fact, when stock rises, there is not that much volume support. So this is the volume line really that tells you that probably there continues to be a supply at the higher side, and whenever we reach close to 420 odd levels, the supply comes in. If you also look at the oscillators, it's still in the corrective mode, which means although the stock finds very strong support at this moving average cluster, these 3 moving averages that you can see is 50, 100 and 200 days moving average, and that is probably a strong base that is being formed. but at higher levels, it's advisable that you should hold on to a long only if it moves and closes above 420. Otherwise, maybe you will find another opportunity to buy at lower levels.
Okay, thanks a lot for that analysis. Remember, this is not a recommendation by any stretch of imagination, more an observation on the charts that Pradeep Pandya has. So watch out if you are indeed holding on significantly large long positions in the stock of Biocon. If you are holding long positions in the stock of Sterling Tools, you need not worry because the stock is locked on an upper circuit today. It's actually gained over 50% in the last 5 trading sessions, and which is why we thought it's best to get in the management to try and figure out what the near term looks like. Because the numbers that came out were pretty strong. Joining us on the phone line is the director of the company, Atul Agarwal. Good having you, Atul. Thanks so much for taking the time out. Let's start off with what I presume is the latest set of news in your company, and that's the quarterly performance. Fairly strong operational as well as top line growth numbers as well. Is this a sign of things to come, or was this quarter a bit of a one-off?
No, I think we can probably sustain these numbers unless we don't. We don't have untowardly government issues. But other than that, we are looking at a strong second half also. We hope to sustain our top line growth and hope to meet the margin numbers for the second half of the year also.
Okay, I think the line was a bit muffled, but let me just try. Am I reading you or am I hearing you correctly when I say that you believe that the top line growth that you clocked in the second quarter of this current financial year is the kind of growth rate that you can manage over the course of the second half as well?
Yes. Just to repeat myself again, yes, we expect the second half to be strong as well. We hope that we'll be up about 15% on top line on a full year basis over last year, and we hope to maintain our margin numbers also. We have good traction with all our customers across all segments, so we are quite positive for how the second half looks for us.
It's about 23% EBITDA margins that you clocked in second quarter. It's something you will maintain, and if that is indeed the case, then I would presume that for the year, with a 15-20% top line growth, your bottom line growth could be much higher than that.
Yes, we expect the same too. We expect our bottom line growth will be probably a lot better than our top line growth. If we do about 15% top line growth, we are hoping that we'll probably be between 20 and 25% bottom line growth.
Mr. Agarwal, your finance cost has been coming down. Could you tell us what exactly is the debt picture looking like?
Well, actually, we are a net debt-free company. We have no short-term debt at all. We have a small, 30-odd crore long-term debt position, but we are sitting on a lot of cash also. So the net debt, we are positive cash, sitting on positive debt. And this is a function of generating strong cash over the last few years and maintaining that strong free cash flow position this year as well. We have some, growth plans coming in the next 12 to 18 months, which will primarily be funded also by our free cash flows.
Mm-hmm. Mr. Agarwal, nearly a third of your business comes from the commercial vehicle segment, if I'm right. What's the kind of traction, order flow have you seen? How is this segment really doing?
Oh, it's doing very well. Starting April this year, all customers, including Tata, Leyland, Volvo, Daimler-Benz, are doing very well, especially Leyland and Tata Motors. Tata has been a good surprise because Tata was suffering for the last 3-4 years, but I think Tata Motors commercial vehicle business is up again. The volumes are very strong, and and I think it's signs of good times to come. My sense is commercial vehicles growth is here to stay for the second half also.
What's the order book looking like in the coming quarters? Do you think the two-wheeler and the passenger vehicle segment will show maximum traction?
So in two-wheelers, we work with market leaders. We work with Honda Motors and Scooters. They've had a great year till now. I think they're projecting to do about 6.1, 6.2 million units this year, which is about 4.8, 4.9 million from last year. That's about a 20-25% growth. So we've had good growth with them. And the largest company in passenger vehicles we work with is Maruti Suzuki, which is again having a very good year, despite the fact they have a 50% market share. I think they are doing very well. So And we have a strong order book with them. We have also done a lot of development work on new products with them in the last few years, which are also coming to crystallization in the second half and for the next financial years.
Okay. Fair call. Atul, we will leave it at that. Thanks so much for taking the time out, and all the best for the quarters and the years ahead. So that's the sum and substance of this interaction. Sterling Tools, which is locked in an upper circuit, and the management believes that the second half will do better or as well as the first half. Overall, they expect a 15% growth in top line and a 25% growth in bottom line, with margins being maintained at about 23%. The stock, Kotak came out with a note. Their target was 350. The stock is already above those levels. It's 380 in the session today. So that's a big move that this stock has had. However, moving on from the micros to the macros, and Bill Maldonado of HSBC Global Asset Management is overweight on India, but believes that valuations at this juncture are expensive. Here are a small slice of a conversation that he had with us earlier on.
We've liked India, and it's been an important part of our portfolio really over the last 4 or 5 years. I think in a regional context, it's very hard to ignore India these days. And India offers a very, very rich kind of investment environment, because not only do you have domestic Indian plays, but there are also a lot of international companies which are headquartered, listed in India, but which are really operating globally. So it's very hard to ignore. We've been overweight. I would say that we're very positive about the Indian economy and the market, but these days the valuation is no longer cheap. 1 or 2 years ago, we could say we could find a lot more cheap situations in the Indian market, but today that's getting a lot harder. It doesn't mean that all situations are expensive, but you have to look around, and sometimes you have to be a bit brave, like with the public sector banks before the announcement of the recapitalization. Those were looking very, very cheap, but it was only a brave investor, I think, that had a position in them. So there's always things to do, but it's getting a little bit harder in India given the valuation levels today.
Bill, so what you're suggesting is you are overweight on India, but with this news of Moody's upgrading India, you will not look to increase your allocation towards the country. Is that what you're suggesting?
Yeah, I would say by itself, it isn't an investable event, let's put it that way. As I say, it significantly underscores the fact that India is on a very positive track. And that's very good news. It's very good news for all of us that have been investing in India for a long time. But by itself, I don't think that it's an investable event.
Since you mentioned Indian markets are currently expensive, what kind of a correction or what extent of a correction will really make it attractive again?
Well, that's an interesting question. And actually, there's sort of a number of different answers to that question. It's a question that we think about ourselves. Of course, a correction would make the market cheaper. It's difficult to see why India would suffer a correction in isolation of other regional or global markets. There doesn't seem to be a reason that we can identify today why that would happen. It's not meaningfully more expensive than many other markets in the region. Of course, the other way that the market can look more attractive is either if it treads water, goes slightly sideways for a while, and the rest of its Asian counterparts continue to go up, or if earnings improve, and that's what we're seeing in India and in other places, is an upgrade in the earnings cycle, which we haven't seen for quite a while. The market has been starved of good news on earnings for really a number of years now, and that can make the market look cheaper as well. So I don't think it's just a correction that we'd look for, but there are other factors that could make India at the market level a lot more attractive again.
Okay, do you really feel that, the factors that probably contributed towards this upgrade, like fiscal prudence or say relatively higher interest rate that also provided a stability to currency and markets, actually were counterproductive when it came to earnings growth or the GDP growth per se, and probably the rating upgrade is not really what is working in favor of equity investors?
Well, that's a good point, of course. Yes, I mean, maybe the market could have had a bit of a sugar rush if money had been easier, money supply had been looser, maybe if the fiscal restraint had also been looser. I'm sure the market would have had a bit of a sugar rush for a while and done very well. But as long-term investors, we're very, very happy with the sort of macroprudential policy that's operating there. The reform agenda of the government, we think, is also very beneficial for the long run for investors. And so, yeah, I wouldn't have chosen the different course, the course that you've suggested, if that were a kind of a choice that investors had. I think the final piece of the jigsaw that led to or must have contributed to the ratings upgrade would have been the recapitalization of the private sector banks. And I think that also is a very good signal for investors, a very positive signal.
If there is any sort of correction and the multiples contract from here on, which are the sectors where you would be looking to put more money in?
Okay, that's a good question. Well, if there was a correction, I think the first question that we would ask, of course, as investors, all of us, would be what drove the correction? Is something fundamentally changing about the outlook for the economy, interest rates, growth, something like that? Assuming the answer was no, and we were still in this sort of global expansionary phase where we've had pretty decent growth and synchronized growth at that. If you think about all the major economies in the world, for the first time since probably 2009, 2010, we can say we've had a globally synchronized expansion. If that was still intact, then obviously that would be a buying opportunity. And as you're in that expansionary part of the cycle and you're expecting the expansion to continue, then cyclicals would probably be the place where you look. And in many markets around the world, I would say including in India, it's still the case that the defensives trade at a premium on average to cyclicals. And at this stage of the cycle, that really doesn't make sense to us. Really, the cyclicals should be closing that gap on defensives. So if there were a correction for whatever reason, that would probably be the place that we would look.
All right, that was Bill Maldonado of HSBC Global Asset Management. He tracks Asia pretty closely, and he clearly mentioned, though they are happy with the upgrade which has come about from Moody's for India's sovereign rating, but clearly he also mentioned that earnings recovery and higher valuations could be a hindrance for any sort of fresh flows to come into India. Well, clearly, and that's been the consensus view. We've been chatting with a lot of foreign brokerages, and earnings recovery and the higher valuation multiples have been the key reason why we've not seen much of flow coming into Indian equities, but the debt market has been receiving a lot of funds. Let's switch focus. Markets are now in the green, and Edelweiss is the stock which is in focus. The stock has been on a tear for the last 1 year. Neeraj has some insight about what the terminal is throwing up, Neeraj.
Yeah, well, so, just thought we'll bring out certain facets of why Edelweiss is in focus today. We've done some charts as well. But firstly, the reasons. I mean, I remember 3 or 4 days ago when the news of the QIP came about, Edelweiss was at about 278 or 279. The was priced at about 285. I think eventually closed it at 280. So they successfully raised this 1,500 crore via QIP. So that is one. I take a stock back to the results that came out, and the numbers were estimates. All the key franchisees for Edelweiss did very well. I think the two key triggers for them now going in the recent past have been how well their ARC business is doing, which is very well discovered, but also how the wealth business is doing, which is really perking up. I think this quarter, the wealth business delivered about 120% jump in revenues, and that speaks volumes about the kind of acceptance that the wealth business is showing as well. Now let's just get in some things that the terminal is throwing in the session today. Look at if you just look at all that's happening within Edelweiss, and we'll do a comparative analysis as well. But 10 brokerage notes as per the Bloomberg terminal, all 10 have a buy call on this one. The target prices may be slightly lower, but the 12-month average target price is about 351, which is higher than the current market price. If you just look at the earnings trajectory for Edelweiss, it's gone up substantially, but with the price moving up as well. And don't look at this valuation, this 5.5 times is trailing. If you look at the forward price to book, price to adjusted book, it's about 4.8 odd times, which compared to some of its peers is not terribly expensive. But as I said, one, the earnings are moving up. Two, the volumes over the last few days have been moving up substantially. So if you just look at what today's 20-day average volume is suggesting, or today's volume versus the 20-day average, but the 20-day average by itself has moved up so strongly that Edelweiss has become a stock which a lot of people are piling on to, checking in and staying put for long-term gains as well. I just thought I'll end this piece with one quick analysis or one quick comparison of how Edelweiss stacks up vis-a-vis the two other listed peers that we normally speak about. And I think the trend that is emerging is that what held true about a year ago still holds true even now. So just bring this up and you will see Edelweiss is the white line, IIFL Holdings is the red line, and the blue line, the turquoise blue line, is Motilal Oswal. And as you can see, this is the price to book estimates trend as per the Bloomberg terminal. And as was the case last year, Motilal Oswal just keeps this significant headroom compared to Edelweiss as well as IIFL Holdings. The earnings trajectory, mind you, are now starting to converge for both Edelweiss as well as Motilal and IIFL too, for that matter. So you could argue about whether this gap will stay, and if it doesn't stay, then does Motilal Oswal come down on the estimates, or do the other two inch up ever so slightly, because the gap is quite large, 8 times versus 4.5 times for Edel and sub 4 times for IIFL Holdings. So it's a question that we don't have an answer to right now, but yes, Motilal continues to rule the roost in terms of the valuations, but hey, Edelweiss is creeping up now firmly above the valuations that IIFL Holdings used to trade some time back. Back to you guys.
All right, that's some interesting analysis on Edelweiss, a stock which has been on a tear, and those were a couple of analyses. Remember, the stock's been trading at 28 times its FY18 earnings, and we've, as Neeraj highlighted, the numbers were pretty good. The stock today has also seen good gains of almost 3% coming about. Let's move on and talk about the other stock. Eris Lifesciences has been seeing healthy gains post the announcement of acquisition of its Indian branded generic business of Stride Shasun in an all-cash acquisition. To discuss the contours of this deal, joining us on the phone line is Amit Bakshi, Chairman and Managing Director at Eris Lifesciences. Mr. Bakshi, good afternoon, and thanks a lot for joining us today. Congratulations on this deal, and looks like the street may have given the thumbs up. The stock price is doing pretty well in today's session. I just want to check, how do you plan to turn around the domestic business of Strides, which I believe has been reeling under pressure?
Yeah, so look, when it comes to turning, it might not be a real case for a turnaround. It's real case to consolidate, because it has been reeling under pressure in terms of maybe not growing to its potential. But the brands are as good as franchisee as I love to call them. So it's just about consolidating these brands. In my mind, these brands have tremendous recall, and they have been around for a long period of time, and also has been representing the top players in their own market segment. So the work ahead of us is to really take this pan-India. Right now, there's a skew more towards south. It needs to move towards across the country. Once that starts happening, the consolidation should start coming.
Okay, Mr. Bakshi, if you could tell us how long will this take, and what kind of investment would you really need to make?
So look, this is something which is core to our business. So the acquired portfolio would sit across 4 divisions of ours, which are already existing. So what it does is basically it adds up to the people who are already working. So there's not much question about how much extra money it takes from that point of view.
Amit, good afternoon. Neeraj here. How would the funding be done? I would guess you would sufficiently fund it for the same.
Yeah, Neeraj, we have around more than 400 crores cash sitting in our book. So we just have to work because, what we earn out of treasury and what we think we should be paying for the loan doesn't make a difference actually. So it will be a mix of both cash as well as some debt.
And you wouldn't need to infuse any kind of new money. I think you kind of briefly answered that. Making this sure. You need not infuse fresh money into this in order to turn it around.
No, absolutely not.
Okay, fair call. Just at least one question from my end. If we just look at how your Q2 was, and now the fact that you have an added advantage in the second half of the year of these businesses as well, can we expect the second half to be stronger than what you've done in the first half?
So, Neeraj, let me make this point. We believe for the industry as a whole, the second half would be better than the first half on the whole. For us, because of this acquisition and even otherwise, it stands true maybe a bit more.
Mr. Bakshi, just a last question. Were you only looking at the Indian business of Strides, or were you also looking to acquire some pockets of the global business?
No, frankly, the global business of Strides is in such wonderful hands, and I think that they'll do pretty well there, and we have absolutely no bandwidth outside India. So this entire deal is for the country itself.
Frankly speaking, with the way global businesses are doing, Amit, I think it's better to be in the seat of an Indian business right now. So thanks so much for joining us today and speaking with us, and all the best with this acquisition as also the second half. That's Amit Bakshi, MD of Eris Lifesciences. Remember, it's an IPO that just got recently listed. At that point of time itself, they were asking for a premium purely because they almost started upon this saying that they, like some of the other businesses, do not have the pressures of the US FDA, and therefore the growth seems a lot more certain than what it is for some of the other companies as well. And we've been hearing this, right? A lot of people saying that we don't want to touch companies which are having this US FDA issue. We might as well stick to companies which are within the Indian domain and likely to do well. The Alchems and the Eris Lifesciences of the world, maybe.
So we see deals actually happening in the domestic business these days rather than the overseas business, as the trend actually was recently.
Yeah, for sure.
Let's move on, and Jay Thakkar of Anand Rathi and Richard Jain of Angel Broking joining us. Jay, first of all, there is not much data available, I believe, but any views on Eris Life?
Absolutely, Pradeep. I would say that despite of less data available, I would say that this stock has been consolidating within quite a steady range, and in that process it formed a symmetrical triangular pattern. In fact, post listing, Pradeep, we saw that this stock saw some volatility. In fact, move higher as well. Towards the levels of 728, and thereafter saw a unidirectional fall till the levels of 510. But then thereafter we have seen a steady move coming in this stock, and then a consolidation, and this consolidation has taken a shape of a triangular pattern clearly. And I think the way the stock has provided a breakout on the upside, I think the probability of this stock now heading higher is quite high. The minimum target which can be looked at on Eris comes to the levels of around say 670. I would say that's the minimum target which one can expect, and above 670 Pradeep, this stock can also head towards its previous highs, and that would come again to the levels of 728. So that is what max we can say. So we cannot say more than that. The previous resistance was 728, and here on with the breakout the target comes to 670, and thereafter 728. On the lower side, I would say those who are already having positions can trail their stop losses to around 590, and the one who are buying fresh, they can also place the stop loss at the same level.
Okay, Ruchit Jain with us. Ruchit, thanks so much for taking the time out. Any index strategy if you do have, and if not, you are pretty bullish on the pharma space, seemingly pharma and allied pharma. Your two stock recommendations are within that pocket as well.
Yeah, good afternoon, Eris. Well, yes, first I'll talk about the index front. We have seen during the last week, in spite of the gap up opening on Friday in Nifty index, backed on that news, we have not seen a follow-up buying coming in on the index front. Whereas the Bank Nifty index is one where we have seen good outperformance vis-a-vis Nifty. So we have been looking at some of these divergences wherein Bank Nifty index has hit its all-time high, but Nifty index has not been able to cross its previous high. So with this divergence, if anyone wants to trade in the index front, then I think one should avoid trading in the index. The outperformance is there in the Bank Nifty index, which is likely to continue. So I think at current levels, if on the index front, there is no trade in Nifty, but in Bank Nifty, one can go long, keeping stop loss below 25,450. And on the higher side, we can expect targets around 26,100 kind of levels. Stock specific, yes, you rightly said, within the pharma space, we are seeing good stock specific momentum, and also looking at the volumes in certain stocks. We have two buying recommendations from this is. One is Jubilant Life Sciences. We have seen on Friday's trading session, the prices have given a breakout from a falling trendline resistance, that too with very good volumes compared to in the recent past. So we believe that this a long consolidation phase has been seen in the stock, and hence the stock after this breakout with good volumes, this should lead to uptrend in near term. One can buy at current levels, keeping stop loss below 633. We are expecting target around 720 in near term. My second pick is a buy call in Apollo Hospitals. Also, this is one of the contra bet, as some sort of underperformance has been seen in the stock in last 3 or 4 months. But if you see the daily charts, the prices have made a lower lows, but RSI has formed higher lows, which is usually known as which is called as a positive divergence. So this divergence usually happens near medium to long term when bottoms are getting formed. So we believe that the downside is very limited now in Apollo Hospitals. The risk reward ratio is quite favorable. From a trading perspective, one can go long at current levels, keeping stop loss below 1025 for target around 1120.
Okay, those were a couple of trading strategies, but let's also get some top trading ideas going from Jay Thakkar. Jay, your top 2 trading ideas would be?
See, as far as cash segment is concerned, among the cash segment, I think BF Utilities, despite the stock is quite high in today's trading session, I would say rather by 8%, but then I think the way the stock has clearly provided the breakout from an inverse head and shoulders with quite increasing volumes with a clear buy crossover in its monthly indicators as well. I would say that on the daily as well as the weekly indicators, we have a clear buy in BF Utilities, but the monthly indicator providing a buy crossover after a long time, after a long consolidation, really means something, that there is a quite good reversal, at least in the medium term as well, and not just the short term. We have seen a decent retest of the inverse head and shoulders neckline, I would say, and then hence the stock is now reversing again and is forming high tops and high bottom. I think the minimum target on the upside comes to on 553. On low side, one can place a stop loss at 478 and go long, or I would say initiate a buy in BF Utilities. The second buy recommendation again from the cash segment would be on Gujarat Heavy Chemicals Limited, wherein I think the wave 3 on the upside seems to have started, and the wave 3 or the wave 5 on a larger degree, I would say, which means that there should be momentum that should catch up from these levels. And then on the lower side, around 241.50 is a very good support. With that as a stop loss, I would recommend this as a buy for a target of at least 276 in the short term.
Okay, in last 15 minutes or so, if you look at the PSU banking index, that index has slipped quite a bit, and in fact there is an update here for PSU banks that RBI wants accelerated provisioning in the next 2 quarters for the second list of NPAs that was released, and that could be a trigger why this index is actually slipping like this. Not a very deep correction, but yes, if you look at it, there is a steep correction, and there has been some supply over last 10-15 minutes consistently in PSU banks. If you look at some of the high beta PSU names like Bank of India, PNB, Union Bank, and see how they have really done, we'll probably get some idea about how the sector is really doing. Ruchit, any stock in the PSU banking that looks interesting to you?
So within the PSU banks, we have seen that after this outperformance, post that gap up opening a couple of weeks ago, more of a stock specific momentum has played. Stocks such as State Bank of India and Bank of India, these are the 2 names which particularly from the PSU banks had shown a good outperformance. But the other stocks have not able to, we have not seen any kind of follow-up momentum coming in some of the other names. So I think this basket would, for at least for short to medium term, there would be more of a stock-specific momentum. We are unlikely to see a significant up move or a sharp up move from current levels in the entire sector as a whole. So within the PSU banking space, if anyone is looking from a short to medium term trading perspective, one has to be very stock specific. We are positive on both the names SBI and Bank of India, but apart from that, from this space, we are cautious, and we are recommending to avoid any other names from the PSU banking front.
Mark a few stocks which have done exceptionally well. One of them is Dixon Technologies, which moves up another 6% today. So 3,070 for Dixon, extremely smart move. Kolte Patil continues to rise and shine, so 300 now, and that is trading at new highs for itself. Sheela Foam is the big one, 13% higher. 1764, and arguably if you look at the last 18 months, this would be yet another IPO which has created a lot of wealth for investors. Came in at expensive valuations, but that hasn't mattered. The last 12 months, Sheela Foam has just had an uninterrupted rise, has done exceptionally well, 1773 and counting. Look at the last 12 months, about 72% and a big jump in just this last 2 days. I think 14% higher today is that big spike that you're seeing in Sheela Foam. The last 1 month about 27%, but again, it's essentially got to do with today's move, 14% in today's move itself, which is a very, very strong move for this pocket. I must say, I don't know what you guys think about it, but real estate sales may not be doing too well, but mid-sized, low-cost real estate housing companies, Purvankara, Kolte Patil, the works, they're just doing exceptionally well. The price movements in these stocks have created a lot of wealth for almost anybody who was invested in these stocks 1 month ago, 1 year ago, 6 months ago, whatever the time frame may be.
In fact, they had a huge surge on Friday itself,
yes.
and the cabinet cleared, they increased the carpet area under the subsidy scheme. So I think the move has come on back of that. In fact, I think the Nifty Realty Index was up almost 4% that day. And you're right, the small time players are gaining out of this because of the thrust on affordable housing maybe.
2.5%, as Navneet was saying. The last 7 days, it's about 4.5%. In today's session, Nifty Realty is up about 2.5% in trade. So that's a big move. Any real estate stocks, Jay, that you would trade?
Definitely, why not? Neeraj, it's DLF that I would strongly recommend. The reason is that recent move has clearly indicated that the stock seems to have really bottomed out. Earlier too, there were signs because the stock had provided a breakout from an inverse head and shoulders pattern. But then we have seen a couple of retests happening of the neckline. In fact, I was not once but thrice. But after doing the retest, it didn't break the pattern on the lower side after having broken on the upside. It didn't fail the pattern, in fact, and then recently it has provided a breakout from a downward sloping channel. So I would say that DLF is strongly forming high tops and high bottom on the daily as well as the weekly charts, and with this kind of an inverse head and shoulders pattern breakout and having retested, it thrives on the lower side. I would say this stock has quite an upside on the I would say going forward. It has a small resistance around the levels of 242, which once it gets taken off, I would say this stock is heading towards the levels of 294 as well. So that's the short to medium term target. I would say 242 and 294. Okay.
Sanjeev Bhasin, Executive Vice President of Markets at IIFL, joins us on the show now. Mr. Bhasin, good afternoon. On Friday, markets corrected from day's high. Today, if you look at it, index are not doing much, but there is stock-specific buying in mid-cap and small-cap. What are you advising? Do you think this pullback that was kind of triggered by the ratings upgrade will hold on and will turn into really a strong uptrend?
Yeah, hi. So it's a glass half full and half empty. Globally, markets are looking very, very uneasy, and we've seen weakness in metals across the board, with China bearing the brunt, and uncertainty on German elections is again putting the euro on a weaker footing. The Dow has been in a correction mode. So in that context, and then in that contrast, India seems to be outperforming on the back of this new impetus which the Moody's upgrade has done. How good it will, it's only a matter of time. I think flows are strong, and on Friday, after a long time, we saw both the FIs and the domestics turn buyers. So I think India may slightly outperform in the short run, but globally, if the correction gathers more steam, then we might be, lukewarm to that. So like I said, I think on the index, you may not find too much of momentum. We don't think a new high may come with this impetus. But it's all about stock sector specific. Like you just mentioned, I think real estate or certain NBFCs or certain, oil marketing companies, that bag of stocks is looking good, and I think Reliance is leading from the front.
Yes, it is. Sanjeev, good afternoon. A bunch of stocks hitting new highs almost every single day. But let's start off by talking about what's not doing that well in today's session, and that's cement. Two reasons, arguably. One, the pet coke ban and the Supreme Court's refusal to take note of it. Two, the price rollback that supposedly ACC and Abuja have done, rolling back their prices to September. Is this a start of headwinds that could stay on for the cement pack for the foreseeable future?
Well, see, firstly, the cement pack was trading at peak valuation. If you took an enterprise value to EBITDA per ton, then I think ACC was trading at about $180, which must be the strongest or the highest we've seen in many years. However, the caveat here is that, Neeraj, since there are a lot of funds which are recently being launched on housing and housing finance and that theme, cement will always find favor with them, even though in the commodity basket it seems to be on the much higher side than normal. So I think any decline will be an opportunity to buy if you are slightly longer term bullish, and given the amount of money which is coming into that same sector, where cement will be also included, then I think any pullback will be used to buy. In the short run, yes, petcoke prices and rollback may be a temporary blip which may last for some time. But now the caveat here is that you're looking for private capex to revive, housing and low-cost housing again to drive demand. And I think come January again there will be some sort of price rise which will come. So in the short term it might be slightly negative, but if you are a longer-term player, then you can't ignore the cement basket, particularly the likes of Ultratech, Ambuja and ACC.
Well, it remains to be seen whether these companies can pass on that extra cost pressure now, which will come in the form of higher power and fuel costs by increasing the cement prices or not. Let's just pull up the intraday chart of Tata Global Beverages. That counter has seen some more gains. In fact, in today's session, it's been gaining in the past few days as well. Tata Global is currently trading almost at day's high. Sanjeev, do you track this one?
Well, yes, this has been one of our top picks all the way from 115 levels, and I think the stock has been a multi-bagger and can still gather more steam. On the back that I think consumption and the beverage market is looking excellent. The Starbucks franchise is gathering strength. The numbers this time showed margins accretion on the upside. Plus, the Himalaya water brand is doing also very, very well. So we've had three top picks and which have outperformed the market. Tata Global, Nestle and Jubilant Foodwork, all three on the consumption side. And if you are looking for an evening, little bit of a evening cooler on your head, then United Spirits fits the bill. Of course, on a decline, but United Spirits has broken all margin expectations, and we think that is set for 3,700 in the next 6 months.
Your target on United Spirits, Sanjeev? Can we see those levels of 4,000 again?
Surely, I mean, I've been one of the brave hearts all the way from 1800, and I was defying, and I said that 63% market share. Diageo now launching, the franchise model, margins going up, and now you have, even talk of prohibition being, eased in a lot of states. So I think no way that this stock should be, not bought on any decline. 4,200 to 4,500 in the next 1.5 years is definitely on the cards.
I want to mark Action Construction Equipment up about 16% in the session today, and it's not just today's move. I think ACE has been moving around for the last few days, but the numbers came out, and I remember the management's interaction with us wherein the management said that he doesn't foresee any problem to a 25% CAGR growth rate till 2020 and possibly beyond. Now that's a tall statement coming in from this one, but they clearly saw order wins coming in during the quarter and commentary from newer sectors coming in. So it's had a really good session the last few, but in today's session up another 16% as well. Maybe the market now is taking cognizance of this. If you just extrapolate those numbers to what the company could do FY21, FY22, it's probably not trading at very expensive valuations. So do keep in mind Action Construction Equipment. The management commentary was very, very strong. What is also looking very strong today is Sanghi Industries, Sanghi Cement really. Let's go across to Nikki, who speaks about this unusual move in Sanghi, which is in stark contrast to what some of the other cement companies have done today. Nikki?
Yeah, that's well put. Actually, at a time when all the cement stocks are cracking under pressure, we're seeing this particular stock holding its neck above the water in green, pretty much with gains of around 8% at the sharpest intraday jump that we've seen in October 31st, 2017. Volumes remain pretty much moderate at 1 time to 30-day average volume, so not a bit surprise there. But then if you look at the stock performance, it's an impressive run by the company. If you see the company on YTD basis has fetched a return of nearly 150%, and on year yearly basis has fetched a return of 122 odd %. So that's a sharp up move coming in from the company. What triggers today's rally? Well, the stock is a low-cost producer, and also given its proximity to lignite mines in Gujarat. Now remember, lignite is an alternative strategy of fueling for the company, and this company is a low-cost producer there. So 75% of its mix is towards the lignite, and 25% comes from the coal. And if you look at the valuations, they are also pretty much cheap as compared to the rest of your cement producers. Be it your Ultratech Cement, Shree Cement, Ambuja Cement, ECC, Ramco, Birla, Orient. Or compared to all these stocks, you would see this particular counter, that's the Sanghi Cement. That is particularly sitting at an EV to EBITDA, 1 year forward enterprise to its EBITDA of 8.1 times, which makes this counter a pretty much attractive bet at this given point of time.
All right, Nikki, thanks a lot for bringing in those details. So something in the cement pack which is bucking the trend on back of that news which came about. Sanghi Industries, a company which uses lignite and coal, is the reason why it is benefiting in today's trade at a time when the other cement players who use pet coke in the northern areas where they have plants have been impacted because of the Supreme Court order. All right, let's shift focus back to markets. Nifty is trading below the 10,300 mark, but clearly today is the day of stock-specific, ideas which are working. You've got stocks like Jaycorp. Pull up that stock. It's locked in upper circuit now with gains of as much as 20%. Let me just get a technical view on this. Ruchit, on the charts, how does it look at levels of 142? I know you can't take a fresh position here, but somebody who's already holding it, can they expect higher levels?
Yes, definitely. If we just see the last 2 or 3 months of time frames chart, then the up moves in the stock in the recent past has been supported by very good volumes, whereas the consolidation phase or any kind of down moves have been led by very lesser volume. So this is usually a positive sign, and after consolidating about 3 to 4 weeks today, again the prices have given a breakout, and if you see the today's volume, then the volumes even in today's trading session are quite good. So if you are already holding the stock, then you should continue to ride the trend on the higher side. As per this consolidation breakout, we could see target somewhere around 160 in near term. So keep a revised stop loss of 130 on the existing long positions. If anyone is having, then continue to hold for targets around 160.
Are you tracking Jaycorp and also RIIL, because both these stocks did quite well in the previous rally in 2006, 2007 actually, and it's believed that once the Trans-Harbour link is actually built, for which an order has been given to L&T now, this could really translate into gains for these two companies. Mr. Bhasin, are you there?
Is that for me?
Yeah.
Yes. I don't track Jaycorp as such of now. So it was some time back. I don't track that. It's a mid cap and I'm not covering that. So I will not be able to give you some views on that.
But quite frankly, Pradeep, I would believe it will be a punt on most investors' part, because I don't know if it's possible to gauge what's the quantum of land bank that they would be having and what's the quantum of earnings growth that Jaycorp can deliver. For long, the belief has been, right, that they have acres and acres of land bank around the Navi Mumbai airport and around JNPT, so on and so forth. Who knows the exact numbers? I mean, it used to be a darling in the 2006 to 2008 move, as you rightly said as well. Every morning you wake up, it was locked on a 5% upper circuit. But, yeah, I mean, so ask anybody, it'll be a punt.
Exactly. So that's why we really need a fundamental perspective here as to how much will the company really benefit. But it's interesting, if you look at the movement in this stock over last 10 years also, these two stocks move up only when there is some development in Mumbai Trans-Harbour link. So whether there is fresh bidding or new fresh interest from some more players, and there have been multiple rounds of bidding here actually. So every time there was some development, both these stocks moved up and kind of failed to sustain every time.
I don't know, unless you are informed, in which over the last 12 years I have not been, when it comes to Jaycorp at least, just very, very difficult to gauge what the earnings growth would be out here. But Sanjeev, if I can push you into this, I know you mentioned that the markets seem a bit stretched on the Nifty valuation side, but let me ask you for something which is a bit of a dark horse, and forget investing for the next 3 months or 6 months. Somebody wanting to park money for say 2 years or 3 years, doesn't bother about what the near-term gyrations might be, and doesn't really want to look at a large cap alternative. Is there a theme? Is there a dark horse? Is there an unusual name that you guys at IIFL have recently run into of late and have researched?
Well, I'll give you two themes. So on Diwali at 170, DLF was my top pick with a 2-year view that reduction on debt, improvement on return on equity, and the foreseeable transfer of wealth creation at 10,500 means that money will go into fixed assets like real estate. DLF would be one of the proxies for that. If you have a 2-3 year window, I wouldn't rule out targets of 350 to 400. The other team was Tata Motor on the back that Slovakia unit comes on stream. Globally, we are in good times for equity, and the wealth creation again means that JLR should be riding the storm. Locally, the CV cycle has turned, so Tata Motor has an excellent risk reward for a target of 600 rupees in the next 3 years. And the third one would be one of our top favorites in the microfinance space called Ujjivan. From a small banking, it has got a scheduled banking license. And after the Bharat Financial takeover by IndusInd, this area becomes very prime for being a takeover target. 650 would be our target on Ujjivan, but again the caveat that these were recommended by us at 320, 170, and 400. Now coming to a theme, if you are looking at battery and electric vehicles being the order of the day in the next 2, 3, 5 years, then you can't ignore the likes of Amar Raja and Exide, which may have suffered because of high lead prices, but we've seen lead coming down along with nickel, and if input prices fall, then pricing pressure will ease, and I think margins can expand. So that seems a very viable place on the auto side. If you're looking for electric vehicles, we think the battery, both the brands have enough monopoly and they are a duopoly, so they will have enough strength to be outperformers in the next 3-4 years.
It's interesting. And a fair bit of large cap flavor out there. So there is a bit of a safety associated with the stocks that Sanjeev Bhasin spoke about as well. Very pertinent at this point of time. Sanjeev, stay on. I'll probably have one more question for you. Maybe Agam, maybe Pradeep and Navneet have some others as well. But it's 3 o'clock. Just quickly get in a sense of what the global markets are doing at this hour, and then of course what the Fab 4 stocks are as well in the session today. But just a small flavor of what's happening across the world, and the European markets are trading very, very flat. But it's anything but flat at the broader end of the spectrum for our markets. And Agam Vakil joins in with the Fab 4 stocks of the day. Agam, good afternoon.
Good afternoon, Neeraj. Well, I have a lot of stocks which are in the mid-cap space, and they've only gone from strength to strength in today's trading session. I'm going to start off with Mayur Uniquoters, a double-digit top-line growth, which is why we're looking at a good 4.5% increase there. We also have Navkar Corp, which gained up as much as 6.3%. This is after a brokerage firm, Spark Capital, has not only upgraded the stock, but also increased its price target to around 220. It's still at 30-odd rupees away from that particular mark. Of course, we've also seen Mangalam Drugs come out with its earnings today, where we have seen a surge of as much as 31% in its quarterly numbers. This is second quarter profits. On the back of that, we've seen a little bit of temperation from its day's highs, still up as much as 1.6%. And of course, Bombay Rayon working on large volumes, where it stands around 24 times its previous 20-day average. And we are looking at a lot of longs building up here as well. These are some of the stocks that I'm keeping an eye on this afternoon.
All right, Agam, thanks a lot for bringing the Fab 4 stocks of the day. But there are other stocks which are buzzing. Let's just pull up Idea. That counter has been active since the morning session, and currently I believe it's trading almost at day's high with gains of almost close to 6%, and it's crossed the 100 rupee mark. Sanjeev, what's the view on telecom? Let's say if somebody was holding, shares of Idea or Bharti Airtel now in a situation where there is increased competition coming from a big player like Reliance Jio, do you think it's worth holding these shares in the portfolio?
Well, if you've been slightly contrarian, 6 months, 3 months or 4 months back, I think we were one of the few who had a buy on Bharti at 340, because we thought that data being the new gold, this consolidation will lead to 3-4 players. And lo and behold, Bharti has been an outperformer of our stock. And we think now with this new 350 rupee having a lot of schemes and variances going on, ARPUs may have bottomed out. We think ARPUs can improve on the upside in the short run. And in the longer run, if you can sit through, then you are aware how much of predominance data is now taking in our lives, and I think these three will reap the benefits. Of course, the valuations look fully stretched at 530, 540 on Bharti. But you know, people are now delving into it on the back of some of the debt reduction which Idea is foreseeing by selling some of its towers and so on. And I think that all will be the hidden caveats where you can sell some of the non-core assets and improve the return on equity. Only caveat here is that the price wars can be a dampener on quarterly results for the next 2-3 quarters. But if you have a 2-year window, then these three will be the outperforming sector and stocks, and you have limited choice. So Bharti would be our topic over there.
Okay, Mr. Bhasin, one last question before we let you go. Have you advised your clients to buy Biocon after the important approval that came in today?
Well, yes, Biocon and a number of other blue chips, frontliners in pharma have been our, constant buys. We've had a sip on them. They've underperformed for some time, and, Lupin, as a disclosure, has been one of our top stocks recommended, but it has been a miserable performer. But we think that the worst may be priced in, and just as you've seen in DVs and now you're seeing in Biocon, we think the road ahead is very clear, and biosimilar seems to be one of the best industries going. Also, I think some of the European, adjudicators, if they get the clearance there, Biocon can be an outperformer. We have a 1-year rating of 600 rupees on Biocon, but yes, our recommendation was close to 330 on this stock.
Okay, Sanjeev, we'll leave it at that. Thanks so much for taking the time out, and have a good day ahead. That's Sanjeev Bhasin of IIFL. Some very interesting thoughts and some very interesting stocks as well. While we're speaking about companies which have done very well in the session, Minda Corp is one amongst them, which continues to rise and shine, another 10% up. And again, the last 1 month chart of Minda Corp will show you what a blockbuster move this stock has had. Dharmesh Kant, independent market expert, joins us right now on the show. Dharmesh, selectively we keep on seeing mid-sized, large-sized auto component companies do extremely well. Minda is a case in point. We just spoke to Sterling Tools some time back, and they painted a fairly rosy picture about their business. We've spoken about a couple of others as well. Where are you on investing in this auto component space, be it CV exposed or passenger vehicle exposed?
See, the entire auto ink space has been looking very attractive for the past couple of years, and we have seen a consistent traction building up. Though auto sales for last 4-5 quarters was not great, but this time again we have seen a pickup in the demand coming back. So to sum it up, what we see is a very good traction going out there in the domestic industry as far as CV and PV both are concerned. And overseas also the markets have improved, be it US market or European market. Traction has been building up. In US, Class 8 trucks have again showing signs of strength, and 10 to 12% kind of a growth trajectory is being predicted out there. I think the better way to play auto ink at current market valuations where they are trading is buy a diversified portfolio kind of auto ancillary stock, which has auto as well as non-auto exposure both there. And in that basket, I think Bharat Forge is the best pick out there. Where they have reduced the exposure to auto from 80 to 60% now, and non-auto is taking more foray into the play. At the same time, they have been more into machined equipments which are high margin, and the price realizations are much better. And Class 8 trucks again picking up in US. So auto ancillary space, you will see flyers like today we have Minda Corp, a couple of days back, a few other stocks were doing well. So this type of performances will come, but on a consistent basis, if you can see for 50-40% kind of attraction in next 1 year's time frame, I think Bharat Forge is the best pick out there. Valuations are still attractive, though on PE multiple it looks stretched, but I think the earnings flow of 30-35% going forward for next 3 years of CAGR will take that into care, and ROEs, operating efficiency, everything is improving. So basket as a theme is a good play. Bharat Forge is the top pick out there.
Okay, Bharat Forge is the top pick in the auto van space, but the 6 out of top 10 F&O losers for the day actually are all the cement stocks, be it Shree Cement, Ramco, Ambuja, ACC, and I don't know why India Cement has reacted to this news. The other bit of news was it's out of the F&O ban, so that's down almost 3%. Ultratech has also seen cuts of nearly 2%. Jay, if I were to ask you which is the best shorting candidate right now among these cement stocks, which one would that be?
Well, I would say that, as of now, as per the risk reward, I would say it's ACC, wherein we can definitely see some good, move on the lower side, and ACC has seen some short, build-up, I would say rather. Ultratech too has seen, a good amount of, short build-up. So I would say both ACC and Ultratech, these two are the best shorts as far as the short term is concerned.
Okay. We'll take a view from Dharmesh Kant on this in a bit, but it's 3:10, so that time of the show when we do a quick check on the F&O space and try and figure out what are the stocks which may either enter into the ban tomorrow or come out of the ban tomorrow. Clearly, it's not worked for India Cements in the session today, but Navneet, what are the stocks that are ripe for either a move in or out of the ban tomorrow?
Well, Neeraj, there are 3 stocks which can enter into the F&O ban for tomorrow's trading session, and I'm just going by the data as of Friday. You look at stocks like Granules India, TV18 Broadcast, and even GMR Infra. If you look at the total open interest of all these 3 counters as a percentage of market-wide position limit is very close to breaching the 95% mark, which is the threshold for a stock to enter into the F&O ban. And for all these 3 stocks in today's session, we've seen a bit of open interest build-up coming about on the futures and as well as a couple of option strikes. So we'll wait and watch whether these 3 stocks come out, whether they enter into the F&O ban or not. But talking about India Cement, clearly I guess it came out of the F&O ban. I'm quite surprised. It's a South player. Why it's tumbling so much on back of that news? In fact, I think maybe the prices...
Price rollback.
Yeah, maybe that's the reason why the entire cement space has been reeling under pressure in today's trade.
Dharmesh, you have a thought here? Cement, would you take chips off the table if you were invested?
Not really. Like as far as if I would have been trading the stock, then maybe yes. But I mean the petcoke, ban in 3 states of UP, Haryana, and Rajasthan has been a blow to the cement industry. Primarily the likes of JK Lakshmi, JK Cement, and Shree Cements. Ultratech also has around 20% exposure out there. So apart from that, ACC, Ambuja, and India Cements are very less concerned. 10-12% is only exposure is out there as far as volumes are concerned. But the second news which triggered a bit of a price correction was the price correction not picking up. But my own sense is that going forward, as we go forward into the next quarter and as we complete this Q3, the cement volumes are going to pick up, and this prices will be passed on to the consumers because the demand has been there. So you can pass on the input price hikes. So price hikes will likely come, and this in fact provides you an opportunity to buy into quality names, and Ultratech stands a case in point out there. So I would be sticking to large cap names which has a pan India presence. Ultratech remains the topic out there, and followed by maybe Dalmia Bharat, ACC, and Ambuja Cement as a buying list. So I would be taking profits from the table in the cement space.
Okay. Jay, if you could look at the chart of Tata Chemical, there has been some interesting movement in last few minutes of trade actually. The stock has been correcting. Do you think it's kind of bottoming out? It's a good time to get in?
Absolutely. In fact, as a disclaimer, I would first like to say that we had recommended Tata Chemicals as a trading idea, and we have just recommended to book partial profits in today's session. I think the stock has clearly broken out from a downtrend line resistance, have completed its wave 4 on the charts after having retraced almost 50% of the previous move, and then the wave 5 on the upside was started. So I think it would definitely take off its previous highs as far as the short to medium term trade is concerned. On the immediate basis, I think around 775 is the target to watch out for on Tata Chemical. And now on a lower side, I would say 720 again, which was earlier a support and a breakout point on the hourly chart. That would act as a good support now. So I think that with that as a stop loss for around 720-21, one can target 775.
Well, the other Tata Group company, Tata Elxsi, is trading at day's high. Pull up the intraday chart of that. Tata Elxsi has gained buying momentum in just last 10 to 15 minutes. It's trading with gains of as much as 4.5%. Richard, on the charts, does it trigger any sort of fresh trade?
Yes, in fact, looks quite interesting even from 1 or 2 days perspective. We have seen that around 920, 922, the stock had a very stiff resistance of the recent past highs. The stock has taken out those levels and now the volumes are good. So I think this stock would head higher in near term. I won't be surprised if anyone in next 2 to 3 weeks itself we see any kind of on upside targets around 1000, 1020. So at current levels, the breakout was just about 922. So at current levels, the risk reward ratio is quite favorable. One should go long, keeping a stop loss below 905 and expect target around 1020 in near term.
Okay, stay on, gentlemen. So much more to speak about. It's 3:15, that time of the show, when we get a sense of what dealing rooms are recommending in the session today. Yatin and Darshan join in with their channel checks. Good afternoon, both of you. Yatin, to you first. What are you picking up from your sources?
Afternoon, Neeraj. MCX, that is one stock wherein we are looking at a good, buying which is coming in at lower levels. In fact, the stock has corrected almost, 18 to 20% from the recent highs, and from current levels, a lot of domestic funds are said to be buyers. Today, the stock is up almost 3%. Apart from that, ICICI Bank is witnessing some kind of a selling pressure. One of the top losers on the index right now, be it Nifty or the Sensex, and clearly dealers are recommending a STBT here. That is the reason why probably the stock would see some more downside. And finally, we have Puravankara projects. That is one stock in the real estate pack, and most of their projects are from the low cost segment. So ever since the government announced more incentives for the low cost housing segment, this stock is witnessing some strong traction, and today also we have a lot of HNIs which are buying in trade today, and Darshan has a few more stocks.
Yeah, so India Bulls Real Estate is one of the counters that's been spoken about. It's almost 7%. It'll be out of the FNO soon. Some of the large HNIs are actively accumulating the counter. They believe that there could be more traction that will come in ahead of the expiry on India Bulls Real Estate. The next one is First Source Solution, trading at the day's high. It's up almost 5%. Buzz of a potential M&A transaction is something that's doing rounds on the counter. We're not sure what this could be, but that's what we've heard. And finally, Dr. Reddy's has managed to crack in trade. Cipla has actually gone and indicated to the exchanges that they've received the approval by the US FDA for a drug called Dacogen. It's a large drug that is owned by Dr. Reddy's. Almost 15% of Dr. Reddy's consolidated profits comes in from this drug. So competition coming into this drug definitely means that it could impact Dr. Reddy's, and Dr. Reddy's is something that dealers are watching out for.
All right, Darshan and Yatin, thanks for bringing that dealing room check. Let's also look at the metal stocks which are rallying in today's trade. The Nifty Metals Index is up almost 1.2 to 1.3%, and its constituents JSPL is the top gainer. That's sitting with gains of as much as 5.5%. As you can see, the gains came in the second half of the session, and JSPL is almost trading at its day's high. Besides that, you've also got stocks like Nalco, Steel Authority, Vedanta, which have seen a good amount of gains. Jay, what about JSPL on the charts? A 5% move, does it warrant any fresh long?
Yes, we are seeing, I would say in JSPL a good amount of long build-up and a good rally coming in. But then I would say the risk reward is definitely not favoring this stock, and this stock has been quite volatile in the past as well. Looking at the past volatility, I would not suggest anyone to in fact trade in this till you don't have much of a confirmation or a better risk reward. As in, if someone really looking out for some metal stocks to buy right now, then I would say SAIL is one stock wherein we had recommended a short few days back, and our target got achieved, wherein it had formed a good head and shoulders pattern, and the conservative target had gotten achieved in its wave 4, and now the wave 5 has started. So I think that SAIL is a good stock to go long around from the short term trading point of view. I think we can see the levels of around say 88, 89 on the upside.
Okay, so that's the call on metal. Dharmesh, what's your call on some of these mid-sized real estate firms that Yatin was also talking about, Puravankara, Kolte Patil being the key buzzers today?
Yeah, they are good bet because mostly they cater to the low cost housing, and maybe a Kolte Patil, Puravankara or Antaraj from the Delhi side. So these plays do look attractive, but my consistent take has been, if you want to play a real estate space, it's better by NBFC housing finance companies which are financer to that, all the housing home loans. And I mean, LIC Housing Finance or DHFL, Repco Home Finance, Canfin Homes, these are available at pretty attractive valuations, and defaults in EMIs are not there as far as low cost housing is concerned. Look at the NPAs; they are so stable and secure. Apart from large NPAs, if you compare that with like banks and all. So, and volatility will be there in real estate stocks because a bit of a news flow can have a big impact on the stock price, whereas housing finance companies are insulated from this volatility. At the same time, our traction has been there because this space was very thinly owned. For the last 4 or 5 years, nobody was looking, nobody was buying into real estate stocks, and now just a thematic play, some fund allocation is there, so buying spurt is there. But valuations wise, I think most of them are fairly valued, or few of them are stretched, looking at the earnings trajectory. So I would avoid, as a real estate space as a whole, rather buy housing finance companies. But still, if someone wants to buy, so maybe Kolte Party, Purvanka, Dantraj, or a Sober Developers can be a good bet out there.
Okay, 320. Let's get in top closing strategies from our experts. Ruchit, to you first. One stock idea, which is a BTST or a STBT.
United Spirits, one can do BTST at current levels. We have seen during the end of the last week, the stock had given a breakout from a flag pattern. And today again, a continuation of that pattern indicates that the trend is still positive. We can see levels around 3300 in tomorrow's trading session. So go long in United Spirits at current level from a BTST perspective, keeping stop loss below 3185 for target around 3300.
Okay. Jay, what about you? Your top call?
Well, Neeraj, I would say I have a call in options. Ujjivan, I think, has provided a very good breakout on the upside. We have seen good long build-up here as well, and post results, we have seen the stock in fact continuously high, moving higher and forming high tops and high bottom, and good build-up of long is also happening. So I think Ujjivan 400 call can be bought at the current market price for a target of 26 with a stop loss of 9.5.
Let's just pull up Jet Airways. The stock is back in focus. It's gained almost closer to 3%, I believe, in today's trade. And no, it's up almost 5%. 725 is the level. And as you can see, major buying has come in last 1 hour of trade. Dharmesh, there has been renewed interest in counters like Jet Airways, which is almost double this year. Do you track this one?
Yeah, definitely, and more of this upward traction has come in the last 25-26 trading sessions, and immediately this was into F&O ban space the moment the traction started coming into Jet Airways. And see, fundamentally I don't think why the stock is trading above 700 right now, because if Brent and WTI has to trade above 60, so this would be running into loss in the Q4 of FY 18 this year itself, because the sensitivity to Brent prices are very high, and Jet Airways is not leveraged. The news flow that they have a tie-up with KLM and Delta Airways of France. So this is a old news where metal ordering kind of a pack they enter, where you can buy a ticket in any of these airlines from the same platform, and the seats, if they are available, that would be allocated to you. But consumers have their own preferences. If I want to fly with Jet, I will fly with Jet rather than an Indigo. So such type of things is still not very explored in a better way. So I don't think that news flow itself warrants such a big re-rating into Jet Airways. Maybe it's a trading play which is panning out due to some sort of a ban activity going out, because last time when WTI was near $60, Jet Airways was trading at 360 and below that kind of a level. So complete disconnect. So I won't be advising investors to invest here. If they have, it's a very good time to take profits out of the table and wait for things to be more clear before re-entering into this stock.
It has been a good month actually for Jet Airways, and if you look at the data, actually SpiceJet was the key beneficiary that gained quite a bit, and the unlisted Air India. But if you look at the stock movements, Jet Airways is definitely taking a lead. Dharmesh, before we let you go, one last sector that is logistics. Look at Gati or Navkar. Even VRL Logistics has hit a 52-week high today. Do you like any of these stocks?
See, logistics as a space has always been, very attractive, and today's, the attraction has been based on a news flow that they may get infrastructures, and that will make the, cost of funds cheaper for these players. But most of them, have been trading at very rich valuations, and this has been their history. Like historically, it's always a very premium valuations at which they have been trading at. So maybe Concord or a Gateway District Park still merits a buy out there, but apart from that, Gati or VRL are at very premium valuations, so I would avoid them. If somebody wants to be invested, so my advice would be Concord would be the best bet out there.
Jay, Ajanta Pharma is the other stock in the pharma space, which has risen sharply. In fact, that's the F&O counter, up almost 5% in trade. How does that look on the chart? It's almost trading at days high now.
Stock has also provided from a multiple resistance breakout. I would say it has formed a good triple bottom as of now in the short term, and the recent rally can extend till the levels of around 1486 on the upside. Why 1486? Because 1486 is the 200 DMA, I think, wherein it can go and test it again. If it manages to surpass those levels and close above that, then it will come out of this bear phase. Else, we can again see this stock sliding, and after retesting 200 DMA, it would inch lower. Also, if you clearly watch out, the downtrend line resistance is also coinciding with the 200 DMA. So I think that is the level to watch out for going forward. But however, the current rally can spike up to the levels of 1486 because the momentum is clearly into the buy mode with a positive divergence. The stock has provided a record on the upside. So bulls, at least for the short term, have an upper hand.
Stay on, Jaiman. So much more to speak about, but it's time that we start wrapping up the equity markets on a day when we've ended fairly flat, but the broader end of the spectrum has really outperformed. Let's start off though with Pradeep, who joins us right now with a quick wrap up of how the large caps have done today. Pradeep, the indices ending with a fair bit of green, but nothing to take home.
Yeah, but not bad because, in last session we had seen a steep correction from days high. Today also, if you look at the Sensex and Nifty, they remained in negative for a while, but finally closing in green, up 10 points on Nifty and 35 points on Nifty Bank. Sensex, although might close in red, I'm saying might because we'll have to wait for the final closing figure that would be adjusted for the average of last half an hour. So we'll wait for that. Look at mid cap and small cap. They were doing better, and that is the really cause for optimism in markets because both the indices, mid cap and small cap, have managed to hold on to gains, and the market breadth is around 2:1. If you look at some of the key movers in index today, we had heavyweight RIL, Maruti, Coal India, Kotak Mahindra Bank. These were some of the key gainers in the index. Somewhere in between, you had Sun Pharma, which didn't do much. Bharti didn't move much today. HUL also was more or less neutral. But on the negative side, we had some heavyweight banking counters like SBI, ICICI Bank and HDFC. They kind of limited the gains for the index in today's trade, and also pharma names like Cipla and Dr. Reddy's.
Like it was a day for broader markets. A lot of stock-specific action was seen today. And let me start off with the cement players which were in focus. The likes of Shree Cement and JK Cement today came under pressure after the Supreme Court extended the pet coke ban to northern states of Uttar Pradesh, also Haryana and Rajasthan. You saw pressure coming up for stocks like Shree Cement that was down almost 4% and closing almost at day's low, so to say 17,508, and JK Cement also closed at day's low with cuts of almost 5%. A lot of news-based reactions coming about. Biocon got clearance for its Bangalore plant, so that's counter closed at day's high with gains of 7.5%. Last quote was somewhere around, looks like 423 to 424. Well, the other stocks, Eris Lifesciences and Strides, both these stocks reacted positively to the acquisition news, where Eris acquired the domestic business of Strides. Eris was up nearly 6 to 7%, and Strides closing almost at day's high with gains of 4%. Couple of mid-cap counters. Bombay Rayon was pretty active today. That counter saw good gains of almost 20%. That's Jacob there on your screen, locked with upper circuit, and Bombay Rayon very close to the upper circuit, closing with gains of as much as 18%. Couple of Tata Group companies companies were active, right from Tata Global, Tata Elxsi and Tata Chemical. All these three stocks surged just in the last hour of trade. As you can see on your screen, Tata Global closing with gains of 6%, Tata Chemical and Tata Elxsi too saw strong gains in today's session.
Yeah, well, and a bunch of stocks hitting new highs as well. I'm sure we spoke about too, the likes of Sheela Foam and a few others. But the market, by and large, this is what the contribution has looked like in today's session. And financials, even Stevens, quite frankly. So out here on the losing side, we've had ICICI Bank, HDFC and State Bank of India. On the gaining side, Yes Bank by being the principal gainer, HDFC Bank and Kotak Mahindra Bank. So financials have been even Stevens. What's cracked today is technology. So it's not just Infosys, Tech Mahindra too down, and Reliance has contributed positively. But I mean, it's been a no-go day, so to say, marginally in favor of what the advances have looked like. The heat map will show you it's a fair bit of, it's a mixed bag, if you will. The green and the reds kind of even out each other, so no big reaction thereof. And just pull up the GD and show you which stocks moved around with volumes in the session today. I think that's the key thing that we should try and bring up on the Nifty GD as well. Stocks which had really had some high volumes in the session today, and the terminal will throw that up and you will see what I'm talking about right here. So top 20-day stocks with highest volumes in today's session. So I think IndusInd Bank, Ambuja and Adani Port and SEZ are amongst the 2 or 3 names that really moved around on fairly high volumes in the session today. That aside, it is an even Stevens day, volumes reasonably okay, and yeah, the most up and most down clearly showing you that how GAIL and Yes Bank were the principal gainers and Ambuja Cement was the top loser, down about 3.5 in the session today. Anyways, final thoughts from our experts, and what would you do in tomorrow's session, Ruchit, on any of the key indices? Would you be bullish? Would you take some fresh trades tomorrow morning?
Well, I think as we also discussed earlier, the Nifty index is not showing any signs of any trended move on either side. So I think this consolidation phase which you are saying in today's session is likely to continue for next 1 or 2 trading sessions as well. The way we saw stock specific momentum today, I think that would be the best thing to do even in tomorrow's session. Look at the stocks which are outperforming in tomorrow first half an hour or 1 hour, and those will be the stocks or sector to trade in. That's what I won't trade anything in the index for next 1 or 2 days, but rather take a stock specific approach.
Jay, what about you? How would you approach the index tomorrow?
Well, Navneet, I think that Nifty has reversed or Nifty had seen some selling pressure in the last trading session, that is on Friday, from the levels of around say 10,350.54, which is 61.8% retracement of this previous fall, right? But on the flip side also I can say that today was a very important day because the selling which we had seen coming in that last trading session on the hourly charts seems to be a wave 4 of the recent move which has started from 10,094, and Nifty didn't close in the negative territory in today's trading session. If that would have happened, then it would have in fact increased the probability of 10,354 not getting taken off. But since that has not happened, until we don't see a negative close on Nifty, I think the bulls have an upper hand, and 10,200 on the lower side is quite a good support, so that would continue to continuously see some buying interest coming in. On the upside, as I said, that 10,354, that's the range to look at. So as of now, the Nifty can trade within the range of this 10,200 to 10,354, but looking at the buying Nifty, I think the probability of an upside is quite high because this is what we have been seeing, and in fact we had mentioned in our reports as well, right at the levels of 25,000, wherein Bank Nifty had provided a breakout from 25,200 on the upside from a bullish flag pattern, which has a minimum or a conservative target of around 26,700, and that's still not achieved. So I agree one thing that from the weekly point of view, or weekly expiry point of view, we are seeing some good open interest build up, seeing at 2,600 call options on Bank Nifty and 10,500 on the monthly basis on Nifty. So we can see some consolidation, but once these levels are taken off, I think again the momentum on the upside will build on. So we are long 25,500, 600 will be acting as a support in Bank Nifty. Keep on adding in whatever dips you see, targeting around 26,000 at least for the weekly expiry point of view, and 26,700 on a positional point of view. And till 10,200 levels are not broken, I think traders should utilize this dip as a buying opportunity, but then 10,200 should be really a strict stop loss, as below those levels I would say that bears will definitely come back into the charge.
Okay, fair call. Jay as well as Rujit, thanks so much, gentlemen, for joining us and giving us those perspectives. By the way, we have a question on social media about somebody wanting to know about any good scripts. He or she wants to invest about 20,000 in equity for the short term. Now, unfortunately, we do not have a fundamental expert right now. We did ask Sanjeev Bhasin about some of his ideas, but I would recommend you tune in tomorrow and about between 8:30 to 9:30, we'll ask our fundamental experts about stock ideas that are good enough for 6 to 8 month perspective. But that can only happen tomorrow. For today, though, it's a wrap on this leg of Countdown. So from Pradeep, Navneet and me, Neeraj, thanks so much for watching. But stay tuned, because immediately on the other side of the break, we will give you the perspective of two large foreign institutional investors who spoke to us earlier on. Kenneth Akinteve of Aberdeen, as well as Bill Maldonado of HSBC.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Let's get in a very special voice from Aberdeen, Kenneth Akinteve. Needs no introduction, of course, but joins us right now on Bloomberg Quint. Kenneth, thanks so much for taking the time out and speaking with us. The first question, and the obvious one, India does benefit with a ratings upgrade. Almost every economy, any country would. We've seen an example with Philippines in 2013 and 2014 as to what happened post the upgrade. To your mind, how significant is this Moody's upgrade on India?
In the near term, you may get a bit of positive sentiment both in the equity market and bond market, but I think from our perspective, this ratings upgrade has been a long time coming. So Moody's is a little bit of ahead of the curve. Obviously, they've had India on positive outlook for a while, but I think the market, both in terms of equities and even the bond market to some extent, has been well ahead of the rating agencies. I think they've generally been quite slow in their approach to upgrading India. We've had almost 4 years of persistent and consistent reform. And obviously there's two other rating agencies, S&P and Fitch, and these rating agencies don't even have India on positive outlook, let alone are ready to upgrade them. So if anything, I think the rating agencies have been a little bit behind the curve, and the market has been well ahead of the rating agencies. So it won't make a material impact in the medium term. I think what will be the bigger drivers of the market is continued commitment to pursuing very key reforms, of which we still need to see a few more.
So yes, well, you can argue that rating agencies typically have been accused of doing rear-view mirror driving. But a lot of people also say that if you look at the rationale that Moody's seems to have given, they are also taking a bit of a forward view, because in their assessment they are taking into account that oil will stay at a 40 to 60 band. They are taking into account that the reforms that have been put in place in India will show material impact over the course of the next 12 to 18 odd months in print as well. And of course, any further upward pressure to ratings will only be dependent on a slew of measures, including the investment cycle picking up. In that sense, do you think that provides a bit of a comfort to, say, fixed income investors, because that's an area that you handle, fixed income investors about their investments into India? Because while the investments were very, very strong for the first half of calendar year 17 into India, the second half has seen a bit of a trickle down into Indian bond markets, also maybe because of capital controls.
Yeah, I mean, there have been a number of factors. We've seen since June inflation bottomed, and as widely expected, base effects easing off. We've seen inflation creeping back up over the last few months with the impacts of demonetization and more recently the goods and services tax. That has caused a little bit of a supply shock in the economy, and because of that negative growth impact, the market did expect that the government potentially would come out with some fiscal stimulus, which we haven't really seen materializing actually. But there are a number of other factors which have also been weighing on the bond market as well. Obviously, the central bank has been doing open market operations that have been impacting the willingness of domestic investors in particular to invest. And as you alluded to, obviously the openness of the market to foreign investors, those quotas have been fully utilized almost, and so you haven't really been able to see such strong foreign investment flows. So I think a combination of these factors has obviously put the market on the back foot. To put it into a bit of context, however, you are in a fairly seasonally weak time for emerging markets generally, and if you compare India to some of the broader emerging markets, actually you've seen somewhat better stability in bond yields over the last sort of month and a half. You've seen fairly marked rises in things like local currency, emerging market debt yields in particularly sectors like US high yield, which has been another popular market. All these areas of the global bond markets are selling off quite markedly. So to be honest, the sell-off in India is not too marked in contrast to that. And generally, you still see better volatility and risk-return characteristics, not just from the bond market, but particularly from the currency as well. At 5 to maybe 5.5, 6% volatility, the rupee is still one of the lower volatility currencies in the emerging markets investment universe. And for us, that is a very important point, because what we're trying to do is construct portfolios that have very good diversification and risk return characteristics and are somewhat immune from some of the potential exogenous shocks that we could be seeing over the coming quarters.
Like you mentioned, bond markets were probably ahead of the curve, and they were pricing in a better rating for India ahead of the ratings that were actually recommended by the agencies. What does it mean now? I mean, if bond prices or the yields were already in sync with a higher notch on the rating scale, when the rating upgrade really comes, will that allow for any further lowering of the yield on Indian bonds or the risk premium on Indian bonds?
Yeah, we may actually see the market find a bit of stability, because if you think about it, commodity markets are already correcting. Oil prices have actually already come off their highs. I think if you look more broadly than that, some of the other commodities like base metals are also correcting. And if we look forward to some of the risks that we may be seeing going into the start of next year, one of the big ones for emerging markets is China. And while we're generally quite positive in the transformation and transition in the Chinese economy, it is likely to be characterized by some stricter policies which may begin to slow growth, and we are seeing some pressures on the property market. And what that may mean if you have a correction in commodities is some degree of negative impact on broad EM, but that would be a positive for India, which generally does better when commodity prices are softer. So I think maybe some of these factors are perhaps more relevant for India. Another big one will be the review that we will get in the first quarter of next year where the policymakers are assessing the FPI or foreign portfolio investor framework and will be deciding on what degree of access they could increase in both the government market and the corporate bond market. So for us, that's an important one. Just to put it into, again, some context, if you look across global emerging market local currency funds, as much as you probably find investors talking about India, the weight of India in these funds is literally about 1% or maybe even slightly less. And for what is one of the strongest reform stories anywhere in the emerging markets, if not in the world, and for a market that can seriously improve your risk return and diversification characteristics in your portfolios, 1% is way too low. They should be running much higher allocations, and obviously to do that, they would need greater access to the market.
And also, I think what attracts money from world over is growth. Now, if you look at this rating upgrade, probably we are looking at a 6% GDP growth with 3% fiscal deficit. That is the target, and maybe 4% inflation. But that may not really be, as per the potential growth of India. So, while the government is trying to be prudent fiscally, and that is probably helping us get a rating upgrade, do you think we are kind of stuck in a low-level equilibrium?
So I think there are a lot of interesting things to come in the coming years. You know, the transition in the Indian economy and in politics and in policy has already been, fascinating to watch and really quite encouraging. But some of the most important transitions are yet to come. So some of the biggest infrastructure projects going on anywhere in the world are happening in India right now as we speak. So these very big investments into, the north-south industrial freight corridor, east-west transportation systems that are going to begin to start tying up the entire country. You will see massive improvements in productivity, drops in logistics costs. And when you combine that with policies like the goods and services tax, I mean, these factors alone could add several percent in GDP in the coming years. Now, it's not something that happens in the near term. You will only start to see some of these projects being completed starting in, say, 2019. So we're talking more in the medium to long term. But nevertheless, this does improve the outlook for Indian growth. And of course, you're also starting to see a lot of traction in new industries as well. Some focused on technology, some that will be focused on things like logistics and warehousing and new opportunities like that. And again, at the same time, this is happening at a time when the policymakers have actually opened up the economy to greater foreign direct investments. So you will be able to see a greater weight of foreign capital coming into play. Some of these emerging stories as well. So I think the medium to longer term outlook for India is still quite encouraging. Obviously, there's still been a little bit of trepidation from the domestic private sector to also participate in that. And obviously, we've still been seeing fairly weak private investments and private credit growth. But I think over the medium to long term, as some of these trends start to play out, you may begin to see also greater participation by the domestic private sector as well. So we're pretty encouraged by the longer term outlook and still think there's a lot of opportunity in the economy and market.
Kenneth, the last 3 months undoubtedly have been a story of domestic flows supporting Indian markets. FI flows have been absent from the equity markets for sure, and I can understand in the debt markets we've breaching limits or very close to limits, so the flows would trickle down. Would calendar year 18 be more a repeat of calendar year 17 in that flows will restart from the FI end, both on the equity and the debt markets, starting the first month itself?
So from the bond market, it will really depend on to what extent we see access to the market being facilitated. There are obviously some things that are already in place to do that. So obviously we are in a transition ever since 2015, whereby the cap on government bonds is being increased from 3.5% to 5%, which will be completed by March 2018. So that does give us a little bit more increased access and potential to invest in the market, but it's still a little bit restricted. And obviously on the corporate bond side, while there have been some easing and greater facilitation by moving some of the Masala bonds out of the corporate bond quotas, there's still a bit of restricted access. So our ability to increase our flows into the market are kind of restricted from the bond side by the capital controls. On the equity market, obviously, there's no such restrictions. The one thing I would say is that the equity market optically does seem a little bit expensive. You're trading at, 25 times PE, if not slightly higher. So clearly a lot of good news has been priced into the markets. The equity market for sure has not been the only way to play the India story, even though this has been one of the most popular ways. But if you look at a 3-year return, actually you'd have got better returns from investing in the bond market, close to a 30% return or 10% annualized. That is higher than the returns you'd have gotten from the equity market. And don't forget, your volatility in the bond market is only about 5%, which is half to a third of the volatility of the equity market. So I think there are still opportunities for investors. There's some constraints on the bond side, and still opportunities in the equity market as the economic story plays out. But investors do have to be mindful of what kind of risk they're taking, and in the current environment and environments we're going to be seeing in 2018, there is a choice to be made between taking that exposure via bonds or via the equity market.
Do you have a target level or a range for next 6 months when it comes to the Indian 10-year government paper or Indian currency?
Yeah, so we forecast over a 6-month time period, and over 6 months, we're actually pretty sure that we can actually see yields moving lower. So our forecast for the 10-year is actually around 6.7%, which would obviously give you a fairly decent capital return, and that's on top of the slightly more than 7% you get from your average yield of the bond market. And there's still also some potential for spread compression as well. India does have a fantastic local currency corporate bond market. It's almost 400 billion in size. It's one of the most liquid local currency corporate bond markets, certainly in Asia, if not across the emerging market world. So there's loads of opportunities to invest in good quality companies that are have quite good liquidity in the bond markets, tight bid-offer spreads. So when you combine all that, potentially over the next 12 months, you could be actually seeing a return from bonds anywhere from maybe 8 to 10%. And we do expect to see better stability from the Indian rupee as well. The central bank has been doing quite a good job in managing the volatility of the currency, and so for us this is actually quite an attractive allocation within the sort of Asian and EM bond allocations. And for us in Asia, this is one of our biggest positions that we have in our portfolios, both in absolute and relative terms, and we will certainly be maintaining that. We've already been increasing our exposure to the bond markets as the market has sold off over the last few months, and we still see this as one of the better investments within the region.
Right, Kenneth, if we can just very quickly slip in one more question. What if the union budget shows a bit of a miss on the fiscal deficit path? Not the trajectory, not the direction, but just a bit of a miss on the immediate path. Would that cause a flutter, or do you think people will take it in their stride?
I mean, we expect to actually see a little bit of fiscal slippage here. Obviously, you've got the recapitalization of the banks, which obviously could be below the line and not necessarily show up in the budget, but nevertheless, there is a debt impact on that. There could be some impact from, indeed, the rise in oil prices. And, there is the need to stimulate some growth in the economy as well. So we're expecting to see a little bit of fiscal slippage. But if you're talking about going from, 3.2 to 3.4 or 3.5, we don't think that will necessarily materially impact the trajectory for the bond market. And we really do expect to see continued commitment to the fiscal consolidation moving forward, because the government has had this as a very, very key focus. And we've been quite encouraged. While the market has had expectations of a fiscal stimulus over the last few months, you haven't really heard the government moving towards that from their point of view. And obviously the Economic Advisory Council to the government was advising to ensure that the government remains committed to fiscal consolidation. So the right kinds of noises are coming out from the government, and we do expect to see that commitment and continued fiscal consolidation. So if there was a marked movement away from that, that would give us some degree of a fairly notable rise in caution. And similarly, the other thing that's more of a risk for us, just because it's very difficult to forecast, is the trajectory from oil prices. Our global forecast for oil, we're already sort of trading above those levels that we had earlier in the year. We do expect oil to stabilize, but it's extremely difficult to forecast. So if you continue to see moves in the oil prices to 70, 75, that would also give us a fairly marked cause for concern.
We've liked India, and it's been an important part of our portfolio really over the last 4 or 5 years. I think in a regional context, it's very hard to ignore India these days. And India offers a very, very rich kind of investment environment, because not only do you have domestic Indian plays, but there are also a lot of international companies which are headquartered, listed in India, but which are really operating globally. So it's very hard to ignore. We've been overweight. I would say that we're very positive about the Indian economy and the market, but these days the valuation is no longer cheap. 1 or 2 years ago, we could say we could find a lot more cheap situations in the Indian market, but today that's getting a lot harder. It doesn't mean that all situations are expensive, but you have to look around, and sometimes you have to be a bit brave, like with the public sector banks before the announcement of the recapitalization. Those were looking very, very cheap, but it was only a brave investor, I think, that had a position in them. So there's always things to do, but it's getting a little bit harder in India given the valuation levels today.
Bill, so what you're suggesting is you are overweight on India, but with this news of Moody's upgrading India, you will not look to increase your allocation towards the country. Is that what you're suggesting?
Yeah, I would say by itself, it isn't an investable event, let's put it that way. As I say, it significantly underscores the fact that India is on a very positive track. And that's very good news. It's very good news for all of us that have been investing in India for a long time. But by itself, I don't think that it's an investable event.
Since you mentioned Indian markets are currently expensive, what kind of a correction or what extent of a correction will really make it attractive again?
Well, that's an interesting question. And actually, there's sort of a number of different answers to that question. It's a question that we think about ourselves. Of course, a correction would make the market cheaper. It's difficult to see why India would suffer a correction in isolation of other regional or global markets. There doesn't seem to be a reason that we can identify today why that would happen. It's not meaningfully more expensive than many other markets in the region. Of course, the other way that the market can look more attractive is either if it treads water, goes slightly sideways for a while, and the rest of its Asian counterparts continue to go up, or if earnings improve, and that's what we're seeing in India and in other places, is an upgrade in the earnings cycle, which we haven't seen for quite a while. The market has been starved of good news on earnings for really a number of years now, and that can make the market look cheaper as well. So I don't think it's just a correction that we'd look for, but there are other factors that could make India at the market level a lot more attractive again.
Okay, do you really feel that the factors that probably contributed towards this upgrade, like fiscal prudence or say relatively higher interest rate that also provided a stability to currency in markets, actually were counterproductive when it came to earnings growth or the GDP growth per se, and probably the rating upgrade is not really what is working in favor of equity investors?
Well, that's a good point, of course. Yes, I mean, maybe the market could have had a bit of a sugar rush if money had been easier, money supply had been looser, maybe if the fiscal restraint had also been looser. I'm sure the market would have had a bit of a sugar rush for a while and done very well. But as long-term investors, we're very, very happy with the sort of macro-prudential policy that's operating there. The reform agenda of the government, we think, is also very beneficial for the long run for investors. And so, yeah, I wouldn't have chosen the different course, the course that you've suggested, if that were a kind of a choice that investors had. I think the final piece of the jigsaw that led to or must have contributed to the ratings upgrade would have been the recapitalization of the private sector banks. And I think that also is a very good signal for investors, a very positive signal.
If there is any sort of correction and the multiples contract from here on, which are the sectors where you would be looking to put more money in?
Okay, that's a good question. Well, if there was a correction, I think the first question that we would ask, of course, as investors, all of us, would be what drove the correction? Is something fundamentally changing about the outlook for the economy, interest rates, growth, something like that? Assuming the answer was no, and we were still in this sort of global expansionary phase where we've had pretty decent growth and synchronized growth at that. If you think about all the major economies in the world, for the first time since probably 2009, 2010, we can say we've had a globally synchronized expansion. If that was still intact, then obviously that would be a buying opportunity. And as you're in that expansionary part of the cycle and you're expecting the expansion to continue, then cyclicals would probably be the place where you look. And in many markets around the world, I would say including in India, it's still the case that defensives trade at a premium on average to cyclicals. And at this stage of the cycle, that really doesn't make sense to us. Really, the cyclicals should be closing that gap on defensives. So if there were a correction for whatever reason, that would probably be the place that we would look.